Hello, friends. Yesterday we discussed on some of the most important elements that you need to mention in the business plan in order to get an easy approval from your investor, so that they will be willing to put the funds into your business. All right. So today I'm gonna be as short as possible, and those are the points that we have discussed yesterday. I have explained you that three important things has to come into picture when you're presenting a business plan to your investor. The first thing is the business description. You need to be as descriptive as possible. You need to elaborate the different element that comes together in order for your business to be well presented. Like in business description, you're going to explain the business overview, the overall activities, and how you're planning to run the activities. What is your audience? What is your targets, age targets, and which country you're planning to do that? What is the type of business you're running? Is that an e-commerce business or it's a physical store business? This all comes into business description. Then the second point, you got a financial projection. In here, you will have to explain to your investor what are the financial activities that you will be undergoing in order for you to be able to return the funds. All right. Because like I told you, any investor is expecting ROI, which stands for return on investment. Any investor want to see how the money is going to come back. If I put money in your business, I want to make sure that I will have profits, and I will have also my principal. I have explained you the concept of principal and interest. All right. And the third thing is marketing strategy. You want to make sure that it's okay to tell me how I'm going to get my money back, but what are your marketing plan? How are you planning to attract customer in the market so that you will be able to generate this profit as you mentioned on your business plan? All right. Today is on 21st. All right. We're going to discuss these three different points. First of all, I'm going to just give you a couple of examples of financial modeling that I have built in past, and then I will teach you how to build the balance sheets, and then we have a conclusion. This is all we're going to see today. We're going step by step until you'll be able to build a financial modeling from the beginning. All right. So let me just go through a couple of files I have put together here. All right. I got this one, for instance. Yeah, this one, for instance. Okay. Yeah, you can see here this financial modeling, how it works. The first page of your financial modeling, you need to put instructions, steps to follow, so that the user of your financial model will be able to identify how they can run the sheets, how they can run the model that you have built. All right. So you need first of all to create an instruction page. This page will show people, it's like a guideline how to use this modeling. All right. I have put a couple of instructions here how you can use it. And the second page, there it comes. You got the source of funds. When you start a business, all right, even if you have a business plan, the first thing before the business will be able to stand on its own, you need to have funds. All right. So usually we have two sources of funds. We have loan from the bank, and we have investors. It's two different things. Let me just put it here so you don't get confused about these two things. All right. Source of funds. You have two different type of source of fund. You have loan from bank or from financial institution, and the second source, you got what we call funds from investor. All right, we call it equity. This is the name. All right, equity is the funds that you get from investor. Equity can have many forms. I think you have heard of stockholders and shareholders and bonds and all this kind of financial security. I guess you have heard all those kind of financial security are called equity. All right, this is the money from investors. So you have two distinctive source of funds. All right, the first one is from a financial institution like bank. All right, the bank is a financial institution. All right, and you have a fund from investor. All right, so let's get back to the modeling here. All right, so look here properly. I have mentioned a couple of banks. This is an example I have built myself, so don't look at the number. Those are just a random figure that I have put there so that to be able to to give an example to the follower. All right, So here you got money from bank. For instance, you have borrowed $7,000, 7K dollars from bank number one, from HDFC. You have borrowed 10K. And for instance, from Procredit, you have borrowed whatever it is, whatever amount it is, and they have given you different rate of interest. All right, at the time of the maturity, you have to pay that money, including the interest. All right, it can be through installments, or it can be through a fixed deposit. All right, then you have a maturity period. Maturity period means the period of loan that you have applied for. If it's for 10 years, for instance, means the maturity period is 10. All right, so you have installments here and blah blah blah. Okay, this is the money from the bank. I have mentioned all this. You can fill whatever bank you have taken loan. You can take loan from many bank. All right, this is the bank. Then when I'm going down, I will explain how you can build that. Don't get confused by the complexity of this shit. You will be able to build it by yourself. Then you have equity, means investor, the people willing to invest. I have mentioned different name here, for instance. All right, Manasi and Maduki and all that. They have put the money together. All right, and here you have total investments of 99. What is that? 99K. All right, this is the total investment. So you need to be able to identify the ratio, like how much is it that you have put from your pocket and how much is it that you have put from the bank. All right, and how much the investor have given. Then you will have a ratio. You know, for instance, that 50% of the money, the total investment, comes from the bank, and 50% comes from the investor. All right, so it means if 50% comes from the investor, it means that the investor have 50% of ownership. So the investor will have 50% of profit. All right. However, if the 50%, if 100% of funds, so assume you have not taken any loan from the bank, all right, it means that 100% of money which you have borrowed comes from investor. It means that the investor has a full ownership of your company. Means the company belongs to him at 100% rate. You understand? So this is why you have to take 50 from investor and take another 50 from the bank. In case you don't have money or you are not eligible to take a loan from the bank, then you can take 100% from the investor. But please keep in mind, you're taking 100% from the investor. It means that 100% of the whole company operation belongs to the investor. All right, so you might be paid on you might be get your remuneration by on salary basis, like you will be one of the employee. All right, so this is what it is about. Then the next page, here you have capital. All right, this is a capital expenditure. It means how you're gonna spend the money. How you're gonna spend the money. You have taken 100K of loan. The total amount is 100K. How are you going to spend that 100K to start your business? First of all, you need to invest in capital. All right, capital expenditure. You're gonna buy maybe land, or you're gonna buy building. You're gonna buy machines. You're gonna buy all this. You're gonna buy. All right, this is everything you're gonna buy. This is just an example. I will show you how to build that. Okay. Then you have bank deposits. For instance, you have saved some amount in bank. You have to mention that on your modeling. You have inventory. I will explain all that. You have payables. Payables means liabilities, the money you have to pay, the money you have taken on loan. All right. And you have expenses for the business to work, to run properly. You need to have some expenses. You have to pay salary. You have to pay marketing fees and all that. All right. And then finally, you have financial statements. This is what I'm gonna discuss today after giving you all the example. Financial statement will show you, it's gonna show you the balance sheets. Three important statements are here. You have a projected balance sheet here. You can see what are the elements in the balance sheet, and you have a cash flow statement here. You can see the cash flow statement. I will explain you all this. Then on the right side, you have the income statement. All right, we call it profit and loss statement. in other term. Okay, I'm gonna explain you how you can build that. I'm gonna show you another type of modeling. This is another type of modeling: capital expenditure, how you spending your capital, equity, the investment you got from the investor, the money you got from the investor. Then you have here inventory, how you controlling your inventory, whatever merchandise, the product that you're purchasing, how you are keeping it in your inventory, how you making sure that inventory is healthy. All right. And then here you got expenses, you have financial projection. All right, you have the balance sheet here. I will explain you how to build all this. This is just an example. Then you have a graphic analyst. Analyzes. All right, this will enable you to have a graphical representation of your company. You have an idea how much exactly your company is producing, and you have an idea who are the different investors through the graphic. This is very important also because it gives a visual communication to your audience. All right, I will explain you how to build all this also. I think you have an idea what I'm talking about here and what is the purpose and importance of financial modeling. All right, in a business. Now let's start from balance sheet. Like I told you, we're gonna go to the second point. We're gonna build the balance sheet. This is the first thing you need to learn, how the balance sheet operates. All right, the balance sheet is the final result after creating your financial modeling. Then you have at the end, at the last page, you can see most of the financial statement comes at last. All right, last pages. Then you have the results of your expenses, the results of your investments, the results of your purchases, whatever you have done, it's coming into the statement. All right, then you will see on the statement. Statement is like a dashboard of your company. All right, I had a picture of dashboard somewhere here. Just hold on a minute. I'm gonna show it to you. Yeah, this is a dashboard. I hope most of you are very familiar with the car dashboard. All right, it gives you an indication of the current condition of your vehicle. All right, you got a speedometer and you have the RPM and you have the tank level. It's showing you how much fuel you have in your tank. All right, this is the exact purpose of the balance sheet. It's like a dashboard. It's showing you the current position of your company. Is your company doing well? So many people who are very much aware with the financial with the finance, they will not finance your business unless they look at your balance sheet. Balance sheet is very crucial to any business because it tells the actual position of your company, whether your company is doing good or bad. Everything can be perceived or seen from the balance sheet. All right, so here we're gonna start building a balance sheet. Like I explained you, we call it statement of position. All right, it's the balance sheet. So in order for you to be able to build the balance sheet, there is what we call how do we call it? We call it a financial or accounting equation. All right, it's an accounting equation. Everything you are doing on a balance sheet, you have to refer to the accounting equation. What is the accounting equation? The accounting equation is simply this formula: equity plus liability equal to assets. Assume your equity, like I told you, it's the investor's money. All right, or your money also can be there on equity. It depends if you have your personal money. All right, equity is the money from the investor. Anybody will put $100 in your business, it's an equity. You would consider that as an equity. However, liability can be the loan from the bank. If you have taken $50 from the bank, all right, it means you have $50 of liability that you have to pay back to the bank. All right, and assets, you have $150. All right, total equity plus liability. You need to make sure how you spend this 150 will reflect on the asset part. All right, so you have 150, your assets must be equal to 150. I will explain now how you can do this. All right, so let's start building a balance sheet. What are the most important elements in building a balance sheet? You have, first of all, assets. All right, then you have liabilities, equity and liabilities, always together. Like I told you, you have to refer to the financial equation. All right, you have equity and you have liabilities. I'm sorry, you have an asset and you have equity and liabilities, all comes together. All right, now look here properly. What is an asset? In French we call it les atouts, les avoirs. All right, an asset is any goods that you have in your company that can help you to generate your revenue. This is what we call an asset. All right, so we have two different type of assets. We have what we call current assets, okay, and we have non-current assets. Okay, yeah, what is a current asset? In current asset we see cash. Those are short-term assets. All right, less than 1 year. Any asset that you have that is highly liquidable means that you can whenever, if you have any problem with cash, any problem with funds, you can sell it fast in the market and get cash in return. All right, this is what we call current assets. Anything that you can sell fast is current assets, starting by cash, because cash itself is already cash. All right, this is the first current asset. The second current asset, money in bank. Okay, your money in the bank. Okay, this is second current asset. The third current asset, then you have inventory. Okay, those are the current assets. There are many more. All right, many more. You can just mention many more than this. All right, just assume you have a cash value of $100. Put the dollar sign. Then in bank you have $50. Then your inventory value. All right, assume you're selling books. The total value of your books, assume it's $70. All right, total value, all your books together. So this is the value of your inventory. All right, then you have non-current assets. Non-current assets you have, like for instance, equipment, starting by buildings. For instance, you have buildings or office, whatever it is. Then you have equipment, for instance. You have machinery. All right, machinery. I hope you know what is building, what is office, what is equipment. Equipment like what office equipment, like chairs and tables and all that. Those are equipment. Assume the total value of your equipment is $35. All right, let me just keep this like this. All right, $35 total value of equipment. What is machinery? Machinery is nothing but any it's like it's anything, any device, anything that can help you to transform a raw material to a finished goods. This is a machinery. Okay, every company, not every company, but especially industrial company that transform goods, they need machinery. Okay, some machines that can help transform a raw material to a finished good. This is what we call machinery. All right, then here we have, for instance, the value of a machinery is $45. Then you got here building, and buildings, assume the value of your building is $120. Okay, so this is the total assets that you have. Let me just bring it down. So the total value of your assets, I'm gonna sum it up, all this. All right, so this is the total value of your assets. Total value of your asset. So we see, we would just say that your total asset is value $420. Okay, $420. Then you have equity and liabilities. Like I explained you, equity is the investor's money. So the investor has probably invested $220. Okay, then you have liability. Liability is the loan that you're taking. All right, loan from the bank. Okay, it can be from bank, or it can be from your supplier. If you're buying any product in the market, you can also take it on loan. All right, from bank or from your supplier. All right, so from bank, assume it's 150, and from your supplier you have taken inventory on loan, value of $50. All right, let me just copy the format. Okay, so the total must be equal, like I told you, financial equation. Okay, total must be equal to your asset. Okay, because you cannot spend the money that you do not have. You can only spend the money that you have. And if you spend, if there is a leftover, then the leftover will come in cash. All right, assume you have spent only 300, then 100 probably will stay in cash, will be there in cash, available money. All right, I hope this concept was very clear. Balance sheet is not built this way. Balance sheet is built through a system that we call a ledger system, which I will explain step by step how you will be able to start building your financial modeling from 0 to 100. All right, this is just to exemplify. You need to understand what is the balance sheet and what are the elements of the balance sheet and what is the financial equation. Like I told you, financial equation, equity plus liability must be equal to assets. All right, you can see here equity and liability together is 420, and total value of assets is 420. The financial equation is successful. All right, this is what is a financial a balance sheet. I will give furthermore example on my next video, but I thought this could be a great idea for you to understand first of all the concept of financial equation and the concept of balance sheet. Thank you so much for watching, and looking forward to seeing you on my next video. Thank you.